Hello, good morning. Sorry for the slight delay. Okay, so now we shall start the morning webinar. Um, okay, the Ling Sing is away for earnings brief, so we will skip the Sheng Siong Group earnings brief. But I'll just leave the slides on for about a minute so you can just take a look at it. Okay, next we will have the earnings report from the Singapore Exchange. It's been a strong performance from SGX as the capital markets have livened up. Okay, so the performance has been supported by a very strong securities revenue and the derivatives revenue. The securities revenue is uh, boosted up by the stronger SDAV. The traded value in the equities increased 14% year on year, and the traded value of the other security products increased 82% year on year. So the the other products that we are talking about would be actually the increase in the trading of warrants, ETFs, and the recently launched DLCs. So these products, in a way, they have lower clearing fees, and therefore it has affected the overall clearing fees for the securities um, segment of the business. The derivatives revenue increased 14% year on year to 80.6 million, accounting for 39% of the total revenue. And this has been on the back of stronger foreign exchange, for FX futures, namely the INR USD currency futures and the USD CNH currency futures, and also the slightly stronger China A50 equity futures. So as I've previously highlighted that some of the regulatory relaxation on the trading of equity index futures in China has improved the volumes, and we believe that moving into early next year, we will begin to see more activity coming in. And the listing revenue is higher 6% year on year to 13 million on higher bond listings. And as for the securities average clearing fee, has been declined, as I've earlier mentioned, the increase in trading of other security products such as warrants, ETFs, and the DLCs. On top of that, there's also higher participation by the market makers and liquidity providers. And this segment of the market participants generally pay lower brokerage fees. So the next would be the post-trade services, down 9% year on year to 26.4 million, accounting for 12% of total revenue. This segment of the business is down because the brokers are migrating to their own systems and no longer need SGX contract processing services. So moving ahead to early 2018, this segment of the contribution would be zero. But it will depend on the securities settlement revenue, which will remain stable and will make up about 88% of the post-trade services revenue. I'd like to highlight that actually our lower target price is due to this post-trade services, as we do not see that this segment of the business will be a growth driver. In fact, the stability itself would hinder the rest of the other the growth segments. And the next will be the new IPOs in FY18 expected to be in the high 20s, which is an improvement of FY17's 22. And finally, our target price is 831 revised from previous 839. With we still maintain the accumulate rating. So next would be Sing Investment and Finance. It has been a continued strong performance as the net interest income continues to increase. The main reasons for the much stronger performance in net interest income is due to the the expansion of the loan to deposit ratios, expanding from 82% in 2016 to 85.7% in third quarter 17. Most of the first half of net interest income growth was due to lowering of the deposit costs, so this has been the main driver for the net interest income growth. And for this quarter, we saw that the deposit costs have continued to come down at an annualized rate of 2 basis points quarter on quarter. But what is more surprising to us, and is a pleasant surprise, is that the customer loan rates have increased at an annualized rate of 30 basis, in our estimation, 30 basis points quarter on quarter, which is a reversal of the first half trend. In the first quarter and second quarter this year, we saw that the customer loan rates actually have come down quarter on quarter, and this is the first quarter in this that they have increased loan rates. And despite increasing that, the customer loans volume has declined marginally to 0.5% quarter on quarter, and this is a show that, as the economy is improving, the market is more accepting of the pass-through of higher rates, and also the positive sentiment helps to sustain and the positive loans growth. All in, net interest margins have improved from 1.72% in the second quarter 17 to 1.92% in third quarter 17. The provision expense has also improved, and owing to the same reasons I've mentioned, the moderate economic growth amid low volatility, and this supporting the asset quality. Our outlook for SIF would be the net interest margins will be is revised upwards from 1.77% to 1.8%. The net interest income growth is projected to improve 14.5% from our previous estimate of 7%. Owing to the fact that we believe in the fourth quarter, we will still see some increase in the customer loan rates. So finally, the FY17 PATMI estimate was revised upwards to 22 million from the previous 20 million. And given such strong performance, we believe that SRF should announce an increase in dividends declared in the fourth quarter 17. Next would be the Overseas Chinese Banking Corp. And again, a strong performance for the finance sector, especially for the net interest income. So the net interest income has increased 12% year on year, and this is one of the best quarters for net interest income. As previously we could see that actually the year-on-year growth for the net interest income has always been in the low single digits, owing to unfavorable loan rates and volume dynamics, where the market is not comfortable with a pass-through of higher rates. So this, as sentiments have picked up, you can see that this is going to be a lot stronger, this net interest income. And for this particular quarter, it is driven by the 11% loans growth year on year. The loans growth beat consensus and also the management's guidance. The loans growth has also outpaced the Singapore domestic loans growth in the third quarter 17. So most of the growth has been led by Singapore corporates expanding into overseas and also Hong Kong-based loans. Right. Moving forward, we think in 2018, we think that there's a strong catalyst for domestic loans growth in the area of housing, especially on the back of strong on block sales momentum. And we also expect some of the public infrastructure projects to come back online after a long hiatus. So in the third quarter itself, the stronger NII has certain characteristics similar to SIF, which is expansion of the loan to deposit ratios. The net interest margins increased 1.66%, 4 basis points higher year on year, on the back of rising benchmark rates in Singapore and Hong Kong. And excess capital is also deployed into high yielding interbank placements, and that supported the net interest margins. So and the NPL, as before the earnings, we have expected the NPLs to be stable. So this when the results came out to prove that point, we are extremely pleased. And that's because the better utilization of offshore oil and gas assets through, although the charter rates and duration remain low. So the management are sanguine about the sector, not that they are saying that the sector is going to recover tremendously or is going to grow at a good pace, but the fact that they have already seen the worst and they do not expect further deterioration affecting the loan books coming from the oil and gas sector. So the other developments is the wealth management income did show a decline quarter on quarter, but that is nothing to worry. That's due to a lower number of blockbuster funds launched in the quarter 17. Moving ahead, we will expect to see the Q on Q growth coming ahead. The main catalyst would be the stronger capital markets, and also as the on-block sales gain more momentum, there will be more high net worth individuals that will be minted, and more of them will be coming on, and they would have to engage the banks to manage the wealth. The next one is the volatility in OCBC's China Treasury business has caused the headline OCBC Wing Hang net interest margins to decline. So as I've mentioned earlier, that the Hong Kong benchmark rates have risen. So in fact, the OCBC Hong Kong and OCBC Macau net interest margins did increase, but it's offset by OCBC China's treasury business. So we do not see that this would be it could be just a short-term volatility, and we will probably see the net interest margins come back. Some of the net interest margins improvements coming in the next few quarters. The net trading income is weak. That's along with the rest of the other universal banks that have been reporting their results recently. So they have all cited a challenging trading environment as volatility remains low. As for the outlook for this segment, still unclear. We do not know when it will improve. Finally, the management has guided for 7 to 8% loans growth for FY18. And that is an improvement of the previous guidance of mid-single digits back in early 2017 and 2016. Thank you. Next, we will have CapitaLand Retail China Trust.
Okay, good morning guys. Teo Hong here. So I will touch on the results for two REITs for now. One in China, one in Singapore. We start off with CapitaLand Retail China Trust. So what happened for them in the quarter was NPI grew, and these were mainly driven by mall rejuvenations at the multi-tenanted malls. So I'll jump right in and touch on the results. So you see that for 3Q17, year on year is up 10%, but in RMB terms is similar, and this is because year on year the Sing RMB exchange rate has been pretty stable. And the growth the extraordinary growth is driven by Capital Mall Sinan, which was acquired in September last year. And then we touched on that as well. Multi-tenanted malls, they had rental growth as well. And this was offset by weaker revenue from Qibao in Shanghai due to the vicinity's competition, and then the divestment of Anzhen as well. If we strip out all these investments and divestments, you can see that NPI grew 6.1% year on year in RMB terms. So flowing down, NPI grew about the same, close to 10%, and there were higher property expenses from the new acquisition. And DPU for the quarter grew 0.4% year on year. So like we mentioned before, the if excluding the impact of acquisitions and divestments, you see that NPI grew 6.1%, which is pretty credible in the recent climate in RMB terms. And this was driven mainly by the growth in NPI for the multi-tenanted, which means the non-master lease malls, and these malls actually grew NPI by 5%. Portfolio occupancy remains stable in the quarter, and what we saw in the quarter is that there is a shift, as we have noticed in many malls, not just in China, Singapore as well. There's a shift away from these departmental stores into higher yielding trade sectors. So for CRCT, part of a departmental store was taken back from the operator, and then the space was carved out into several smaller leases and then leased out to higher yielding sectors like fashion. So you see that for September 17, total gross rental income, only 6.6% were coming from departmental stores, as compared to 1 year ago, you have it at 17%. In all, tenant sales is slowing. 3Q17, the sales was down 2% year on year. 2Q17, it was up 1.9%. For the various trade sectors breakdown, leisure, surprisingly, and supermarkets were weaker, and F&B was strong, were still relatively strong. If we look at the current yield of 6%, this is actually at post GFC level of -1 SD, and we think that this is a fair valuation given that for CRCT, as the malls mature, they are having tenant sales and the rental reversions coming down, stabilizing at about mid single digits right now. So with this kind of valuations at -1 SD, as rental reversions come down and as the malls mature, we think that this valuation right now is pretty fair. And that leads us to our neutral rating. We maintain our neutral rating. Target price is 164. So we jump back to Singapore and we talk about Frasers Centrepoint. So likewise, I think operating environment remains tough as well, not just in China, Singapore as well. But for FCT, the gross revenue was down slightly. This is um, this is mainly impacted by the planned vacancies in North Point. That mall has been up for renovation works, is already completed. So, but in the last year, it has impacted revenue. So if you exclude that impact, you see that gross revenue is actually pretty flat. It's up 0.5% if you exclude that, and if you exclude the impact of the new acquisition. So all in, distributable income went up 1.6%, but this is as a result of the management taking a higher proportion of management units in unit, management fees in units rather than in cash. So taking more fees in units actually frees up more cash to be paid out to unit holders. In FY17, it took 70% of the fees in units. So over the next few years, you can expect definitely this ratio to come down to closer to the average of about 20% in a normal year. So we expect that if any growth for in rentals for the trust going forward, that should be mitigated by the fact that you will slowly start to see a reversion of fees being paid in cash more over the next few years. So for FY17, they had rental reversions at 5.1%, pretty credible for the kind of environment that they're facing right now. But the thing to note is that even at 5.1%, you're seeing signs of stress in that this is the lowest kind of figure ever in the trust history. And I think primarily this is as a result of them being able to build on what they were what was seen as a still relatively low occupancy cost of close to 16% in FY16. So if you look at suburban malls, this occupancy costs tend to peak in the late teens. Um, if you look at the annual report for CMT for 2014, you see that across the region, suburban malls, this ratio tend to be in the mid to high teens. So any ratio creeping up to the high teens, you should see that rental reversion should be harder and harder to come by. So for FCT, FY16 was 15.7. They were able to build on it. And this quarter, it actually went up to close to 18%. Before I go on to touch on this, I'll talk about the catalyst for better upcoming performances in North Point and Changi City Point. We have seen the renovation works for North Point complete in September this year. Management is confident of filling up the mall before Chinese New Year next year. Target was for the gross rental revenue to increase 9% post the AEI, and they are on track to achieve it. And as for CCP Changi City Point, we saw the opening of the downtown line 2 weeks ago, and that should benefit the mall as well, because right now you will have a complete integration for the mall to the Expo downtown line MRT station. So with this opening of the MRT station, I think over the next few years you can expect the occupancy in that mall to improve as well. So like I mentioned, the rising occupancy costs would actually make it harder for FCT to sustain future rental reversions unless you have tenant sales improving. And for FY17, tenant sales actually fell mid-single digits. Um, if you include North Point, which was partially closed during the renovation works, then you have it at about 7.5% down. So for the different trade sectors in the mall, F&B did well, services did well, supermarkets were stable, but fashion, as we can expect, the more susceptible trade sector to e-commerce threat, that sector was the laggard. For current valuations of 5.4%, if you look at the blue line on the left, this valuation is actually at the -1 SD post GFC valuation, and at this kind of level, we think that the positives are already in the price, given that headwinds remain in the retail sector, and add to that the higher occupancy cost that FCT is facing. So all in, we maintain our neutral rating on FCT. Our target price is 214. Okay, I'll pass on to Guangzhi for Ezion now.
Hi, good morning. It's Guangzi here. So the next we'll talk about the update on Ezion Holdings Limited. So last week, Ezion held a briefing to update his current status and what the plan will be for moving forward. So you can see our title is to resolve through warrants, bonds, and convertibles. So as of now, Ezion's is still remain trading suspension. However, it already settled the negotiation with banks. So now let's take a look at the bank side. So the 6 banks will provide up to $100 million to the group to fund its
current working capital. That means the 6 banks unanimously extend the existing loan to Ezion. Also, the banks they are willing to take 200 basis points reduction of the interest rate for this 100 million US dollars loan. So as a result, Ezion must repay a minimal fixed principal every month over the next 6 years. That means this new loan this new loans period is for 6 years moving forward. However, all these terms are based on the condition that Ezion can get the approval from the consent solicitation statement CSE from the note holders of all series. So the next we will talk about the bond side. So as of now, Ezion's positions of the position to creditors are shown here. So there are 6 series of notes outstanding. So from series 3 to series 7 are straight bonds, and series 8 is the perpetual bond. So the total nominal value of these bonds arrive at 575 million Sing dollars. So Ezion will provide a proposal of the notes restructuring for all these series of bonds, and this proposal will involve conversion of these 3 bonds into convertible bonds, as well as the grant of warrants for these convertible bonds. And it is worth noting that these warrants are detachable and non-tradable. So if all these warrants are fully exercised, Ezion will raise additional 344 million Sing dollars. And as a result, this proposal will trigger potential dilution of the existing shares. So the assumption of the dilution is shown here. But of course, these assumptions are based on those warrants are 100% exercised. So in terms of operation, Ezion will conduct strategic transformation of deployment of assets moving forward. So there are several points here. Firstly, they will focus on 100% deployment of lift boats. They will also consider to convert several service rigs into lift boats. And they expect the charter rate improvement will only happen in the second half of next year. And also they will enhance the deployment of other assets fourthly, they will minimize the capex costs, and lastly, they will also dispose of assets that are generating low returns, requiring high capex, and are difficult to deploy due to oversupply. Of course, these strategic transformation are on the prerequisite of the implementation of those restructuring plans that I mentioned above. So this is the timetable for the subsequent events. So the most important events for Ezion is the consent solicitation exercise meeting and contingent adjourned CSE meeting if it is required. And the last one is the shareholders EGM. So for this CSE meeting, they require 75% of attendance rate, and they need to get 75% of the consent from the attendees to approve the bond restructuring. So for EGM, they need 50% of the shareholders to approve the bonds restructuring plan. As of now, because all these plans are involved in several groups of interest, so that means Ezion needs to get through several hurdles to survive its ongoing operation. So the next is the Q&A section.
Hi, there's a question on FCT for North Point. So the question is that for North Point North Wing, after the renovation, what is the impact that we think will be on DPU after considering the fact that management may take more of their fees in cash after this? So we think that for the net impact for the post AEI in the after the increase in MPI and after factoring in the gradual reversion of the management fees in units from 70% this year to a normalized level of close to 20%. I think our forecast is that for FY18, DPU growth will be around the 3.5% region.
Okay, we have a question on why we are bullish on OCBC with high target price of 13.48, as in regard with recent news reporting that other analysts are cautious on a buy call for OCBC. Okay, so let me bring it back to earlier this year and late last year that that on our side, myself, that I'm a bit more cautious of the banks earlier this year, and then there's a sudden change now, of course. Okay, so if you look back earlier this year, there's a lot of there's still uncertainty is coming out from as the oil and gas sector. That's one. Second is that the loan volume and rate dynamics have been poor, as we are not seeing that kind of improvements in the global economy. And then thirdly is also some of the uncertainty that is going on in in Greater China. The rates are still low. Policy making maybe perhaps still a little bit uncertain. But as we go into the second and third quarter this year, we begin to see that there's that kind of momentum that is gaining pace, especially if you look at what's happening politically in China. You can sense a greater certainty coming out from there. So it's a lot of macro-driven factors as well as political-driven factors. So as long as we see that sort of clarity, right, the risk-on momentum will continue, right? Loans growth will improve, and more importantly, as when this kind of economic sentiments pick up, market in general will be able to accept the higher pass-through of high interest rates, and that's very important because that kind of positive dynamics is accretive to the banks. So that is why we change the outlook quite fast, right? That is in line with basically how fast the markets can change. So bearing in mind that, of course, if things deteriorate and then we see that it's going to deteriorate much further, then things can change also. But at the meantime, I believe that the momentum is strong for the banks in general. The conditions are a lot favorable for them. So as for the other analysts, I'm not sure. Maybe they would have used some form of um, quantitative sort of valuations using maybe some Damodaran discounted cash flow or something like that, which might bring them behind the curve lah. So yeah, so I think that's a divergence in view. Thank you.
Okay, if there are no more questions, then we will call an end to our webinar this week. Thanks everyone for attending our webinar, and we hope to see you guys again next Monday. Thank you.